One of the key components that you have to lock into your brain is this idea that everything is financed. It's a concept called the finance trap. My mentor, who mentored many people across the United States, R. Nelson Nash, used to convey this truth that you need to rethink your thinking, because we've been trained to think in a certain path, in a certain direction, in a certain way. It's become kind of second nature to us. It's all we're familiar with. We're just taught this is the way to do things when it comes to your finances. And the privatized banking system is radically different from that. It's new, but at its core, at its essence, what we're trying to do is to help you, our clients and our advisors that are part of the Wellington family. We're trying to help you transition your thinking so that you're no longer thinking like a bank client or a bank customer, but that you're thinking like the bank president or like the bank owner. So we want you to, as our name implies, become your own banker. So bankers think radically different about financial transactions than bank customers do. So a bank owner's perspective doesn't look at transactions and acquisitions like a bank client does, or a bank customer. So a bank customer, for instance, if they were going to buy a car, we'll just use an example. Let's say that we're going to buy a $30,000 used car, okay? This $30,000 car, there's only two ways we can acquire that. Well, most consumers, the bank customer, will come from the position of how much are the payments and can I afford it, right? And both those things are detrimental approaches to purchasing a car. In fact, people close to me, my son had recently purchased a vehicle, and one of the things he was focused on was how much is the payment? Can I afford the payment? And of course, I've trained my kids and family members, loved ones, friends, close people that are close to me, and so he knew going in that's the wrong approach, to focus on the payment. But anyway, so let's talk about this aspect that everything that we ever buy is financed. So sticking with our car analogy, if you go to buy a car, you've got two options. The way that the 95% of the United States does it is they borrow the money for the car. Well, when you borrow the money, then what you end up doing, obviously, is paying interest. So it's not, confusing. Everyone knows that there's an interest payment. Why is there an interest payment to the bank or to the financial lending institution? Why is that present? Well, because they took the time to accumulate the capital. And see, capital is king. That's why our company name is Wellington Capital Reserve. Capital is king for us. Most people don't even understand what it is. I've talked to lots of people in the financial world that don't understand what it is. So capital, if it's accumulated, can then be leveraged to acquire all the things that you want in life. So in this case, the finance company or the bank, the lending institution, had accumulated $30,000 at least, right, in capital. And so they lend you the money. So what you end up doing is paying interest. Now, a lot of people here focus on what is the interest rate. But I would submit to you, that's thinking like a bank consumer, a bank customer, not like the bank owner. Because the bank owner doesn't consider the rate, they consider the volume. And your bank account agrees with the bank owner and his or her perspective of this. Because let's say that you, on this vehicle purchase, that you got a 7.99% interest rate, whatever rates are at the time you're viewing this. Let's say that you get a 7.99% rate on this vehicle purchase. Well, your bank account doesn't recognize 7.99%. When it goes to draft this payment out, that'll be sent to the finance company or to the mortgage company or to the bank, the lending institution. It calculates what that transfers into, a payment of $612.93. That's interest volume. That's what a banker pays attention to. Again, banking customers look at rate. Banking owners look at volume. So we want to teach you to start focusing on what's the volume that I'm paying for this. In fact, in the United States, if you add up all the different things that are financed, your house, cars, college education, home improvement loans, credit cards, personal loans, and on and on and on the list goes. If you stack all those up in the typical household, again, not the rate, because the rate doesn't matter as much as the volume does. That total volume adds up to 34.5%. So 34.5% of your take-home pay in the United States is going toward interest charges, finance charges. Those fees related to someone else has the capital, right? So you're using their capital. 34.5%, that's a huge chunk of your take-home pay. It's just flying out the door. You get nothing for that. Once that money is spent, it's gone forever. The second way that people could acquire that vehicle, and the only other way that they have to choose from, is to pay cash. And so Dave Ramsey and other people of his ilk have affirmed this as a wise financial choice. And not to get off on Dave Ramsey, some of the things Dave Ramsey says are valuable, especially what he says about eliminating debt. However, the one-size-fits-all approach to investing into the next level of wealth accumulation is not really there's much better sources to go to than to go to Dave Ramsey for wealth accumulation. Debt elimination, yes. Wealth accumulation, no. And most clients that we're working with in the privatized banking space are beyond Dave Ramsey. They're beyond the eliminating debt phase. So if they pay cash, they pay their own cash, then they're still really financing it. What they're doing is they're giving up the right, or they're losing interest, the interest that they would have gained if that money had gone into an interest-bearing account. Like our accounts will pay 4 or 5 or 6% net, somewhere in there, depending upon the time frame and what's happening with the economy. So they're losing that interest rate. Why are they losing it? Because they've spent it already. This is called lost opportunity cost. In other words, you've lost the opportunity to earn interest on that money. Why? Because you spent $30,000 of it to buy a car, right? So once you spend that money, it's spent and gone forever. We don't want you to do that. We want you to retain or keep that money. But if you add that up, the first year alone, depending upon your tax bracket, it's somewhere between 8 and 12% that you're losing. Over the next 20 years, an easy way to calculate this, it's a factor of 2.2, which means if you paid $30,000 for that car, what that actually cost you was $66,000. So follow me on this. The price of the car is $30,000. But the actual cost to your personal economy is $66,000. Well, Scott, how do you get that $66,000 figure? Because if you took that $30,000 and you put it in one of our accounts and you just let it sit there, if it had never left your personal economy, that's about what you would have. Now, again, these are round numbers, but you'd have somewhere around that figure. So you're still financing it. So whether you're borrowing the money and paying interest or paying cash and losing interest, both ways you're caught in the finance trap. So what we help our clients do is we add a third option. Now, if you're not currently privatizing money, you don't have a third option, okay? But if you begin privatizing money, we give you a third option, which is becoming your own banker. And when you do that option, you're actually leveraging the cash value. You're using your own cash value inside of your account as collateral. So then the insurance carrier will send you, they'll make the payment. They'll send that $30,000 won't come from your account. It'll actually come from the insurance carrier's account. They'll send the money to you. You go purchase the car, so you have the title in hand immediately. Okay, so you purchase the car, and then just like you would have financed through Ford Motor Credit or GMAC or whomever, you think of yourself, position yourself as being the banker or the finance company. So that same payment that you would have sent to Ford, you send to yourself or you send back to the insurance carrier. Okay, so that money stays inside of your personal economy. You don't lose interest and you don't lose the opportunity cost. You capture both of them. So understanding the finance trap is key. You've got to get this. Every single transaction you make is financed. Every one. You're either borrowing the money and paying interest, or you're paying cash and losing interest. If you step into the privatized banking space, you'll then have a third option, which is becoming your own bank, right? Using the insurance carrier's money, using your cash value only as collateral, which means it stays in your account and it earns uninterrupted compound interest for life. So that's what makes these accounts so powerful. So that's the principle of the finance trap.